Part 4, Chapter 9, Accounting for Inventory Changes, Errors, and Purchase Commitments. Now, changes in inventory methods. You change an inventory method. Most inventory changes are treated retrospectively, except if you change to LIFO. Now, other methods, you would have to revive comparative statements. So if you show 3 years, you've got to show all 3 years based on the change. You've got to adjust the accounts, adjust beginning retained earnings, and you've got to have disclosure. However, if you change to LIFO, it's going to be a point in time, and then of course you'd still have to put it in your notes, but you do not do it retroactively. So now let's take a look at an example. In 2021, Mike Corporation changed its inventory method from FIFO to weighted average. At the beginning of the year, the inventory was valued at $32 million using FIFO, but the records indicated that using average cost, the inventory would have been valued at $23.8. Now, this would require retrospective treatment, requiring the total difference shown as an adjustment to beginning retained earnings. That's your journal entry right there. Also, you would have to restate, if you show 3 years, you'd have to restate the 3 years. So, again, this is treated as a change in accounting principle and would be treated retrospectively. All financial statement amounts for individual periods that are included for comparison with the current financial statements are revised for period-specific effect of the change. Also, the nature and justification has to be disclosed in the footnotes. And again, we're going to have to do the cumulative effect to beginning retained earnings. Now, changes to the LIFO method. When a company changes to the LIFO inventory method from any other method, it usually is impossible to calculate the income effect on prior years. To do so would require assumptions as to when specific LIFO inventory layers were created in prior years. A company changing to LIFO usually does not report it retroactively. LIFO method is used from that point on. Base year inventory is the beginning inventory in the year the LIFO method is adopted. So that's all you have to remember. You don't have to do it retroactively. Now we're going to look at inventory errors. Now, inventory errors. Overstatement or understatement of any inventory. It could be due to mistakes in the physical count or pricing, or mistakes in recording purchases. Now, how do we treat them? It depends. If the error is in the same accounting period, the original erroneous entry should be reversed and the appropriate entry recorded. If the error is discovered in subsequent accounting periods, previous year financial statements should be retroactively restated. That means you got to go back. Incorrect balances are corrected by journal entries, correction to the balance and beginning retained earnings, and you have to have a disclosure note explaining the nature and the impact of the error. So let's take a look at an example. Now, in 2021, auditors discovered that $4 million of the inventory was recorded in 2020 instead of 2021. The physical count at the end of 2020 was correct. What would be the adjustment? The 2020 financial statements that were incorrect as a result of the error would be retrospectively restated to reflect the correct cost of goods sold. Income tax expenses, if taxes are considered. Income from operations, net income, and retained earning when those statements are reported again for comparison purposes in the 2021 annual report. A prior period adjustment to retained earnings were reported. A disclosure note should be described, the nature of error and the impact of its correction on each year's income from continuing operations, net income, and earning per share. Now, what does our journal look like? There it is. We would debit inventory and credit retained earnings. Now, the last thing we're going to cover is something called purchase commitments. These are contracts that obligate a company to purchase a specified amount of merchandise or raw materials at specified prices on or before specified dates. Protects the buyer against increases in purchase price and provides a supply of product. Inventory is recorded at the lower of the contract price or market price on the date the contract is executed. Now let's look at an example. On September 6th, Mike signed 2 contracts. The first was to purchase inventory for $100,000 by November 31st, and the second was to buy inventory for $150,000 by February 28th. They used the periodic inventory system. The first commitment was exercised on November 31st for only $80,000. And that's when the value of the inventory was $80,000. We assume that the market price for the second contract was $125,000, and when it was exercised for the second contract, it was $110,000. So let's look at our journals at the end of the first year, November 31st, when we actually bought the inventory. So we paid $80,000 for it. No, the value was $80,000, but we had to pay $100,000. So we have a loss on purchase commitment. Now, what happens in the next year? Or, I'm sorry, at the end of the year when we still have one more purchase commitment, but the value has dropped. So on December 31st, what we're going to have to do is first determine our estimated loss, which is $25,000. So we're going to have to journalize estimated loss on purchase commitment and set up a liability. Now, what happens when we exercise the second purchase option for $110,000? So purchases are going to be booked at $110,000, but unfortunately we have to pay $150,000. We take our estimated liability off the books and we book the additional loss on purchase. And that ends my presentation for Chapter 9, Part 4.